After a busy big tech earnings week, Wall Street is reassessing its sentiment on tech titans such as Apple. Shares of the iPhone maker sliding as it warns of a $900 million tariff headwind this quarter. Our next guest, though, says this is still a top tech pick for 2025. It is Dan Ives, Wedbush Managing Director and Senior Equity Analyst. And Dan, it's great to see you. And there's a lot to dig through in terms of big tech earnings. But let's start with Apple here. I believe you raised your price target. We see the stock pulling back a little bit today. And just like everything else, a lot of uncertainty here, an environment where Tim Cook doesn't feel comfortable really projecting very far out what is going to end up happening.
Yeah, and Julie, me and you have talked about it a lot. Like, I actually think Apple should be up today. Because when you look at the India pivot, I think this is Hall of Fame. I think the history of Apple, this could be one of Cook's biggest accomplishments, given what we're seeing in terms of the tariff tornado. And in terms of the $900 million, if you told me April 2nd, $900 million would be the incremental cost, that would be like a gift. I mean, my thought was potentially $2 billion. So I get it, just in terms of the reaction. But to me, like a week from now, I think the stock's higher than it was before they printed last night.
How much of this, Dan, do you think comes down to the uncertainty of Apple executives on that call saying, listen, we can't tell you what that tariff impact is going to be past the June quarter?
And look, Josh, you know Apple as well as anyone, right, over the decades. Like, there's just no way Cook is going to give anything outside June because, first off, they don't know the rules of the game. It all comes down to China negotiations. They're pivoting as quickly as they can to India. But I continue to think, like, they're pivoting to India, and India is probably going to be one of the first trade deals done. And I think it would be, very, very surprising, and I think probably, not the smartest thing, if they gave any guidance past June. Because I think that the fact that they gave guidance at all, I think, is a huge positive.
Dan, what do you think iPhone growth looks like, let's call it, over the next 4 quarters? Because there are some analysts, Dan, who think it's going to remain relatively muted until that personalized AI, that updated Siri comes to iPhone.
I disagree on that, just because my view is, like, look at the China number. I mean, you go back to last quarter, down 11%. Constant currency was flat. Like, the irony is, like, China is actually, you're now getting to a point that you used to have a year-over-year increase in China. So I think when you look at steady state growth, it's going to be, call it, mid to high single digits as we go into, let's say, the next 3-4 quarters, but eventually double digits. Now, clearly, AI is going to play a huge role there, but it goes back to, like, services, despite whatever, a slight miss. I mean, that is Rock of Gibraltar like. Look at the free cash flow. And I think you put it together. I mean, there's a stock that's closer to 300 than 200 over the next year.
Dan, we've been talking about margins and tariffs. What about demand, right? Because we know that consumer sentiment is certainly not great right now in the U.S. So what do you think U.S. sales are going to continue to look like?
Yeah, and that's part of from a tariff perspective. I mean, Apple gets it on both sides from the supply chain perspective, but then of course consumer confidence goes down. $1,000 iPhones, obviously those are going to be tougher and tougher, in terms of the price points. Look, I think it comes down to like when you look at the install base and you look at how many have an upgrade in, call it 4 years, you're still close to what, 275, 300 million? So if you take more negative view, you're going to be looking at 235, 240 million iPhones sold and I think get 250 million as we go into next year. When I put that together, I mean, relative to the numbers that we're seeing today, I think now like Street's cut numbers and it's set up outside of tariffs for actually this probably starts to be a bottoming process in terms of growth.
Dan, broadening it out, which is the big tech earnings report this season that impressed you the most? Was it Apple or another name?
Microsoft. I mean, that was a shocker.
How come?
That was a Saquon-like quarter, right? I mean, the point is, when you look at what you saw in Azure, 200-bit beat, accelerated over the coming quarters. The abandoned data center story the Pinocchio story, that's done. So the point is, like, that was for Nadella. That was, I think, just a pivotal moment to show what's happening at Microsoft, what demand looks like. Look at that guide. I mean, I think this is a stock that's actually going to get stronger and stronger. And look, in software, that continues to be a safety blanket trade in this storm.
Switching gears, we want to get through a lot with you because we know you cover a lot. So I want to ask you about Tesla because you know, of course, we're saying that Musk needed to recommit to Tesla. He seemingly did so, right? Although still 1 to 2 days a week in DC is not nothing. Then comes the report that the board had been exploring, searching for a replacement for him potentially. The board said, no, that's not the case. What do you make of all of this sort of back and forth? It feels a little messy, Dan.
Yeah, of course it's messy. I mean, and again, is smoke, how much is fire? Look, Musk has spent the 1-2 days in DC with Doge, the same chances that I'm playing for the Knicks in the playoffs. Like, I mean, his days at Doge are essentially done in the Trump White House. So that's my view. And it comes down to, like, however the board did it, shareholders, part of why we were so adamant and so loud is because the brand damage hit the point where the clock struck midnight. He had to choose. He did a phenomenal job on the call, and I think that was probably one of the best conference calls that he's done, choosing Tesla. He continues to be the biggest asset for Tesla as CEO, autonomous, optimist future. But when you get into, like, board, what happened, the reality is, like, look, there was massive pressure. And I think Musk felt it. And I also think, look, Doge took on a life of its own. I don't think he ever expected the consequences from a brand perspective and what this was going to become around the globe.
Do you think that there's been a lot of criticism of the board, that they had not done their due diligence in the past, that they had not sort of overseen him enough, that they were all too close to him? Does this kind of report show that they're at least making an attempt at
it
trying
shows,
to,
like, not asleep at the wheel.
Yeah.
Or exactly, like, Julie, you're exactly right. Like, I think that's always been the knock on the board, like rubber stamp board. Like, you know, Musk basically rules it. It doesn't matter. Now, regardless of, like, what's true, what's not, look, I think the reality is, like, the board had their back against the wall. They had to make, I think, decisions, and there was pressure. And I think Musk felt the pressure too. And that's why that was a much different Musk on that conference call than I've probably ever heard in terms of the beginning. And I think he read the room, and the future of Tesla should not be taken down because of Doge. And I think that's the reality. And I think he chose the right path.
Great to see you, buddy. Have a terrific
Great
weekend.
to see you.
all right, let's go over to Josh Lipton with those numbers.
All right, Apple's numbers just crossing. Let's get right to it. Q2 EPS $1.65. The street was at $1.62. That's a beat. Revenue $95.4 billion versus expectations of $94.59 billion. So beats there on the top and the bottom. Top line grew about 5%. Gross margins clock in at 47.1. Let's get to the segments. iPhone $46.84 billion. That is versus expectations of $45.94 billion. Services $26.64 billion. Street was at $26.72 billion. Mac $7.95 billion. iPad $6.4 billion. Wearables, home and accessories $7.5 billion. Greater China, now that comes in at $16 billion. Consensus was more around $16.8 billion. Now, front and center for Apple investors this quarter, we know it's tariffs. What is Apple's messaging going to be there? Its strategy, its game plan. Apple is saying wait for the conference call, which is going to start shortly at 5 p.m. Eastern for that. As well as we know, we're waiting for guidance. We'd expect to hear more about that on the call as well. I did get the chance to speak to Apple's CFO, Kevin Perek, about the quarter. Just give you those comments. On the quarter itself, he said, new all-time high for Apple's install base of active devices. Kevin mentioned Apple iPhone revenue up 2%. iPhone active install base, he said, all-time high. Double-digit growth for upgraders, he noted. All-time revenue record on services, pointing out that was up 12%. On iPhone, in Q2, one question that's top of mind for the street, for investors, did Apple see evidence that consumers were buying iPhones to get ahead of those tariffs? Front-loading, so to speak. Kevin Perek telling us for the March quarter, we don't believe we saw any evidence of pull-ahead demand for iPhone. On China, I mentioned that comes in at 16 billion. Street was close to 16.8. Asked Kevin Parekh for some more color there. Parekh saying December quarter, we were down 11%. His point being that they are seeing sequential improvement because now you're down minus 2%. I asked him about local competition. Some analysts think, listen, is that a factor? Has that become more intense over there? Kevin Parekh said it's always been intense. China has always been a very competitive market. We're focused, he said, on simply building the best products. Finally, on Apple Intelligence, its new AI features, I asked him any updated timeline on when European and Chinese regulators approve Apple Intelligence. No updates, Kevin Parekh said, to talk about right now. Guys, back to you.
Josh, there's one other thing I want to mention here that stands out to me, and that is a big new buyback authorization, which seems to acknowledge here, some of the troubles that the stock has had and some of the potential rockiness going forward. $100 billion buyback here that the company is authorizing. It's raised its cash dividend to 26 cents a share as well. So returning some of its still ample cash to shareholders, perhaps as a sort of carrot or an enticement to try to weather this period here. Did they have anything to say in particular about the decisions on that cash return?
So this is always the quarter when Apple does update its capital return program, right? So investors would be expecting that news. On that point, in the statement, CFO Kevin Parekh does address that. It says our March quarter business performance drove EPS growth of 8%, $24 billion in operating cash flow. He says allowing us to return $29 billion to shareholders. He noted, Julie. All right, well, as we are continuing to listen here live to the Apple second quarter earnings call, let's bring in now Bob O'Donnell, Technalysis Research LLC president, for more on the very latest. Bob, it's always good to see you. Let me get your quick thoughts, Bob, on the print, your reaction to the results, and then what we're hearing from the call. We'll mention Tim Cook just saying here right now, March quarter saw limited tariff impact. June quarter, not able to estimate the impact precisely. It's too uncertain, but for some color, he said, assuming current rates don't change, no new tariffs added, impact could add, he said, $900 million to costs for the June quarter. Your reaction, Bob?
Well, first of all, it was a great quarter, and it's great that Cook dealt with that question of pull-in versus not, because the hardware numbers in particular were very strong. I think a lot of people immediately assumed, and I even saw some initial write-ups that, that was based on tariff pull-in. Well, sounds like, according to what they're saying, it actually wasn't. So they did obviously make a bunch of adjustments. We all saw the stories about them flying in all kinds of iPhones from India in the perhaps concern that there would be additional tariffs. But look, net, they did very well. Services was slightly below what the street expected, but it's still a very solid number. And of course, that's their highest profitability business right there. So I think it sounds pretty good. He left open enough question marks moving forward that they've got some wiggle room. And yet at the same time, I think provided a little bit of security around, hey, this is where we think it's going to be. And I think all in all, it's not a bad number to be talking about.
So that $900 million number is what you're saying is that does not seem that damaging in terms of perhaps what people were expecting and what it does to Apple's business, Bob.
Yeah, I mean, they're doing $60 billion plus a quarter, right? So, I mean, it's not that it's nothing, to be clear, right? I mean, it's $900 million, right? But at the end of the day, for some of the real doom and gloom people who've said, it's going to be a complete and utter disaster, I think you have to say, well, okay, yeah, it's not great, but theoretically it could be worse. Of course, we all know, unfortunately, it could be worse, because if things change, then all of this gets thrown out the window. And that's the biggest problem, right? It's all the uncertainty we have that's putting people on pause for making a lot of big purchases, consumers and businesses.
It's interesting, Bob, when Cook started the call, the way he was highlighting the supply chain, the diversity of that supply chain. What did you make of CFO Kevin Parekh's comments to the Journal talking about this, saying the company expects that a majority of iPhones sold in the U.S. in the June quarter will come from India, and a majority of its other devices sold in the U.S. this quarter, including iPads, Macs, Watch, AirPods, will come from Vietnam. Your thoughts on those comments?
Well, look, Apple has been very clear about their shift from China to other Southeastern and Asian countries, including India, Vietnam, et cetera, for a while, right? And so that's not really a big surprise. Perhaps the percentage is where the surprise is. But again, we saw they airlifted things. It shows they have the ability to move some critical manufacturing to other places. Obviously not to the U.S. yet, and that's a whole separate discussion, but they can clearly move some of this out of China, which I think is important because we are going to look for a world where we need to have more geographical diversity from a supply chain perspective in the tech industry in general, and Apple's leading the way in that regard. Now, the question becomes, well, wait a minute, all these Southeast Asian countries also got hit with huge tariffs, which kind of actually in some ways helps China. So, we still need to get some clarification on how the tariffs are going to work in different parts of the world. But clearly, I think Apple sees that they need to move some of this stuff. They had started this process a while ago. None of these kinds of changes, by the way, happen overnight. They don't happen in a quarter. They don't happen in a year. They take several years. And Apple's been working on Indian manufacturing for several years. Same with Vietnam. So all of these changes are things that have been in motion and now are being accelerated. And it makes perfect sense. And I think we'll see it continue.
Let's get to earnings now. We have Amazon coming out in just the past few moments. And really what stands out to me, let's just hop right to it, is the second quarter operating income forecast of $13 billion to $17.5 billion. Now, two things there. It's short of estimates is number one. The average analyst estimate for operating income was $17.8 billion for that second quarter. And the other thing that stands out to me is how wide that range is. $13 billion to $17.5 billion, an unusually wide range, which reflects the unusual and uncertain operating environment under which Amazon is operating right now, and so many other companies as well. We talked about the effect that tariffs are having both directly on the company and indirectly on the company, on the sellers that operate on its platform. It gives a lot of services to them, so all of that having an effect. So that's the forecast, getting that out of the way. Now let's talk about the numbers for the last quarter. And those numbers looking pretty good on balance here. First quarter earnings per share $1.59. That's versus the $1.36 that analysts had been looking for. AWS net sales $29.27 billion. That is just shy of what analysts had been anticipating. And so that also could be a focus for investors here. But Josh Schaefer here with me on set. And overall, the numbers last quarter looking good, but that outlook is a bit of a punch.
Yeah, absolutely, Julian. You mentioned it. It's really the range there, right? Thinking about the fact of swinging from operating income of anywhere between $13 billion to $17.5 billion. We're playing with very large numbers here. That is a significant amount of money that we were talking about that is up in the air. So basically sort of feeding into what I think a lot of the investor fear has been around Amazon, which is an extended exposure to China, extended exposure to tariffs, and what does that actually mean for the company? And perhaps they're saying a little bit right now, they're not quite sure yet, right? And I think that feeds into the moment a little bit. Other thing I wanted to point out here when you were highlighting second quarter net sales, that's also a rather wide range-ish, relatively, 159 billion to 164 billion. The estimate was for 161. But again, just a decent sized range there when we're starting to play with high numbers. I think it's going to be interesting when we get to the call to really sort of hear a little bit more commentary on exactly what they're factoring in terms of the high end and the low end of that operating income. Like, is the low end full China tariffs? Is that sort of the fear here? How do you sort of assess that part of it? But again, shares are down about 5% right now, and I think that's really probably just the key driver.
Yeah, I'm looking at the release now, which is just coming through and doesn't have a lot of commentary around that guidance. Presumably we'll get that on the call here. But the company does have a long list of what is going into the financial guidance. They do say it is subject to substantial uncertainty. It says the following forward-looking statements reflect Amazon's expectations as of May 1st, 2025, and are subject to substantial uncertainty. Our results, they say, are inherently unpredictable, could be materially affected by many factors. Foreign exchange rate fluctuations, changes in global economic and geopolitical conditions, tariff and trade policies, and customer demand and spending, including the impact of recessionary fears, inflation, interest rates, regional labor market constraints, world events, the rate of growth of the internet, et cetera. But you get the idea here that there is this weight, this cloud hanging over them that includes just a lot of X factors right now.
And it's interesting, especially with a company like Amazon, Julie, right? Because they do have so many different parts of this business. They're talking about recessionary fears and consumer spending. Obviously, Amazon sells stuff online to a lot of us, right?
Yeah.
So that's part of the story always with Amazon. But then it's also the B2B part of Amazon's business, AWS. And how does cloud spending play out if we do get some level of an economic slowdown? How does ad spending play out if we get some level of an economic? Every little piece of their business is, yes, tied to the tariff story perhaps, but also just tied to the economic story that's built off the tariff story. And there's so many different offshoots that I'm sort of curious what the focus is going to be from investors as we move out of the call, right? What part of the business matters the most right now and are we most concerned about or could be a driver?
Yeah, it's a great question. For more reaction to Amazon earnings, we're bringing in Rohit Kulkarni, Managing Director and Senior Research Analyst at Roth MKM. You heard us just talking about Amazon here and the diversity of its business, which at times is a real strength and superpower for Amazon. But at a time like this, Rohit, does it mean that multiple different parts of its business are vulnerable at the same time?
Yeah, absolutely. I think the surface area of risk and the surface area of exposure to China tariffs and geopolitical and macroeconomic uncertainty that Amazon has is unlike any other. So they solve a complicated problem, they get rewarded for solving that. But when there is a complicated problem that presents itself, I think the complexity increases. I think in the release and the stock reaction, I would just flag two things. One is after Microsoft, after Meta, after Google, I think the expectations were slightly elevated. The beat was expected, but raise was also expected. I think that's what was the expectation going into the print. So I think in isolation, these are really solid numbers, but Q2 guide, as you exactly said, Julie, the margin guidance is below expectations, and we'll need to find out what's going on over there.
Rohit, it's Josh here. I'm curious with that second quarter operating income guidance, the range just sticks out to me, right? We're talking about 13 billion to 17 billion. I mean, what do you make of the range and what do you think is going on there?
I think there are a couple of things that are one-time in nature. So recently, they started to launch these new satellites. That has been something somewhat delayed. Probably there is a one-time spend in how much they're going to spend on Kuiper and the entire kind of low Earth orbit satellite launches that they're doing. I think that probably requires some explanation. But on top of that, probably there is around how much are they going to spend on AI and AI-related kind of improvements across the entire spectrum of things. Amazon, we know, is going to spend more than $100 billion in CapEx. That flows through the operating expenses and that starts to add a thicker layer of spend. So I think these two questions would probably help us understand, is this a one-time hit that the company is taking in margins, or is this something that as the year progresses, probably we got to add more spend? And plus, there is obviously the China tariff unknown that nobody knows how to solve that.
No, they do not. Rohit, two follow-up questions to that. One, do you think there is any risk that they will be cutting that CapEx plan?
So far, what we have heard from the three other large companies, Google, again, Meta, and Microsoft, they are strong and long on AI. So I expect nothing else from Amazon as well. From a long thesis perspective, I think Amazon has the biggest, again, surface area of being the biggest beneficiary of AI going forward. They have the video platform, they have the advertising platform, they have the cloud platform, and of course, they have the e-commerce. No other company has the various different pillars where each of those pillars can benefit from AI and infrastructure spend. So I feel I think, if any, in fact, just as how Meta increased their CapEx yesterday, we wouldn't be surprised if Amazon also does the same today.
And when we're talking about that operating income forecast, put it in context for us. How does Amazon usually approach these forecasts? Does it tend to be conservative? You know, should we assume that they're going to come out and beat that forecast? How should we be thinking about that?
I think the wider range probably implies there are certain one-time costs that they may or may not incur. That's my first interpretation. But historically, very rarely has Amazon missed on on their operating income forecast going back many quarters. So I feel there is an extra layer of conservatism, and there is an extra layer of perhaps one-time items that they may be incurring, like the Kuiper launch I mentioned. So in my opinion, street numbers would probably grind slightly higher. And so if we hear not too many negative things on the call, like capex or whatnot, then we would be buyers of Amazon shares tonight in this weakness.
Now, shall we get to Meta here? That company out also. First quarter earnings per share beating by a pretty wide margin here at 643 versus the 525 that was estimated. The company coming out with a forecast for second quarter revenue of $42.5 to $45.5 billion. Analysts have been looking for just over $44 billion in revenue. And the company says for the full year, it looks like it is changing its expense forecast. So this is not necessarily its capex, but I guess its capex is included in this. So total expenses this year, $113 to $118 billion. It had been $114 to $119. So it is bringing down its total expense forecast for the full year, but just by, not by a huge margin at this point.
Yeah, it'd be very interesting to see how they talk on the call just more about the broader online ad market and environment, just because obviously the extent that you would see any kind of economic slowdown here, Julie, or maybe even a recession, I mean, what would that mean for the advertising market and for Meta in particular? CapEx, I mean, analysts didn't think we would see much of a pullback there, just given the importance we know the company is placing on AI. Tariffs and trade tensions with China, there is some concern on the street about China-based advertisers and actually whether they may pull back. But listen, right now, at least initially, that stock's popping in the after hours.
Yeah, and just to give a few other numbers here that we got, I know Dan Halley was looking for Reality Labs just to see how much money it lost, and it did lose $4.2 billion. It's a little bit smaller than the loss that analysts were anticipating. Revenue for Reality Labs coming in at $412 million. The estimate was for $496 million. Now, obviously, that's a relatively small part of Meta, but it's a part that Meta has put a lot of energy and effort into. So that's something to keep in mind. The family of apps revenue, which is the vast majority of its business, at just under $42 billion, $41.9 billion for Meta here. And I'm seeing the capex guide specifically here, $64 to $72 billion, which is actually an increase here. So expenses overall going down a little bit, but capex estimate is going higher, $64 to $72 billion. You were talking about what was going on with that. So interesting to see a little bit of an increase.
Yep.
Yeah,
not surprising.
Meta reporting a beat on revenue for the first quarter. The company also increasing its full-year capital expenditures outlook. Scott Devitt, Wedbush Securities Managing Director, joining us now to discuss. Scott, it's good to see you. I want to start with just the overall numbers here and the forecast for second quarter revenue of as much as $45.5 billion. We just heard from Meta's much smaller cousin Snap about this time yesterday, and it seemed like they were having some ad sales difficulties and foreseeing potentially more. Are we seeing any evidence of that of Meta? It doesn't seem to be showing up in these numbers.
Well, I think Snap has a scale issue in terms of its ad platform, so it's a totally different conversation. But at the aggregate level, the advertising industry is holding up quite well. As you mentioned, Meta beat top line, beat profitability by even more. I think relative to consensus, it was a 14% beat in profitability. It bracketed the consensus for 2Q, despite fears that Chinese e-commerce companies like Temu are potentially going to spend less on the platform because of the removal of the de minimis exemption that's pending. Meta doesn't seem concerned about that. And then, as you mentioned, CapEx going up, which shows confidence in the business for the full year. And I would also note that the company lowered its OpEx guide for the full year by $1 million as well. So another moderate positive on a net basis. So this is an extremely positive report, especially in the face of that kind of glowing concern of the China e-commerce pushback. The final point that I'll make is that, it's interesting because last quarter when companies reported, the dollar had just completed a period where it strengthened by 4 percentage points. And this quarter into the guides, the dollar had depreciated. So it's a nice offset to this uncertainty of tariffs to be able to guide into that kind of favorable light, especially with Meta having 60% of the revenue coming from outside the US.
Scott, I'm curious, separately, this very high-profile fight the company finds itself in with the FTC in Washington. I'd imagine, your clients must be asking you about that, Scott. What are you telling them?
Well, so Meta has an issue, Alphabet has an issue, everybody has an issue. That's a large company these days with the government. But I continue to believe that the backdrop with this administration is more favorable than the prior administration. It hasn't quite played out yet, but I think as these issues come to resolution, that we're going to find that the administration itself has a preferential view of U.S. technology companies, and also, nobody in government really wants to disadvantage these U.S. mega caps relative to their Chinese peers. So I'm anticipating an outcome that is essentially a slap on the wrist type of outcome and not something that meaningfully impacts the trajectory of Meta. And that goes for the other players as well.
One of the surprises we've been talking about in the Meta numbers as well is the idea that it raised its CapEx forecast for the full year to $64 to $72 billion. That, again, was a bit of a surprise here. What do you think is driving that, and what do you think gives Meta the comfort to be able to do that?
So there's two topics here. One is, as you described it, the comfort. So that means the company has confidence in the strength of the business and is comfortable continuing to spend. So that's a positive. The other thing is that investors are distinguishing between companies that are spending CapEx from an offensive standpoint versus defensive standpoint, because some look at what Alphabet's doing and think that's more defensive to keep up with the risks related to AI and its search business. And investors tend to look at Meta's increases in CapEx as being favorable because they're well positioned in terms of AI. I don't know that that's the right answer or not, but that's the way investors tend to look at it. And so this raise from a CapEx standpoint, it comforts investors in both of those areas in terms of the aggressiveness of the management team to be front-footed spending, and also in terms of the comfort that they can attain their revenue expectations for 2025.
Scott, some of your colleagues on the street, I know, they're very excited, Scott, about Llama. This is Meta's open source large language model. I'm curious whether you share in that excitement.
Maybe a little less enthused than some others. There's a lot of models out there, and I've heard more favorable feedback from some of the competitor platforms, but we'll have to. It's early days, and open source particularly is super early. So I think Meta will be well positioned, whether it's LLM leads or its LLM is used to add intelligence to its own platform. Either way, I think the company can win. But Llama itself, I think there's a few others that have an early advantage.
What do you think about the decision of the company to sort of offer it as a separate app? Do you think that's going to be, because now people use it, but it's not like they're opting in, right? It's just sort of built into the product. So now that it does, I guess they're doing both. It's not or, but do you think there will be that significant sort of opting in and usage of that separate app?
I think that companies like Meta and like Alphabet that have massive global scale, effectively every internet user uses the product already, is benefited by bundling the services into the core. And so I would anticipate, whether there is an individual separate offering over time that stands on its own, the vast majority of usage and success or failure of it is going to be based on how it's integrated into the core platform. And that's unique for their business relative to the startups that have nothing to leverage, but are gaining traction because the products are so good. But it's just the way, strategically, that it makes the most sense for a company like Meta.
Scott, good to see you. Thanks so much.
That's right. Let's start things off with Meta. They kind of had the more interesting of the two stories. They beat on both the top and bottom line, but more importantly, they offered better guidance than initially anticipated. They say that Q2 revenue will come in between $42.5 billion and $45.5 billion. The street was looking for $44 billion. And so this kind of assuages some of the concerns for now that there's any kind of advertising slowdown coming as a result of the tariff uncertainty and broader economic uncertainty. Again, they beat for the quarter. They had EPS of $6.43. Expectations were for $5.25, and revenue came in at $42.3 billion versus $41.3 billion anticipated. And I just want to point out, they also raised their full year CapEx estimates. They went from $60 billion, between $60 and $65 billion, to $64 billion to $72 billion. So a big jump there, and that's obviously related to all of the AI spending that they're going into. By the by, Meta Reality Labs segment had an operating loss of $4.21 billion for the quarter. So obviously not doing the best there. But let's switch over to Microsoft. They also beat on the top and bottom line. They saw cloud revenue of $42.4 billion. That was up 20%. One of the important things to point out here is that AI contributed 16 points of growth to Azure revenue. Now, Wall Street was expecting 15.6 points, and basically Microsoft was saying that that's a result of getting more capacity online. They've been repeatedly saying that they're capacity constrained. It's causing headwinds. It's why their AI isn't as growing as fast as they would like, but now they're starting to get that online, and they're starting to be able to meet the demand that's already there that they haven't been able to meet before. One of the other things I want to just quickly point out is on the personal computing side, and that's the PC business. They saw revenue of $13.4 billion. Wall Street thought it would come in at $12.6 billion. And part of the reason is that Windows OEM partners, they brought in more sales into the current quarter, just as kind of building up the inventory, because they said that inventory already was elevated and it remains so. So it's an idea of that pull forward of PC sales or PC shipments, just trying to get ahead of any kind of tariff uncertainty in the prior quarter.
We earlier talked to Brent Thill of Jefferies, and he said something that kind of stuck with me, which he said, these are two desert island companies. In other words, if you're a chief information officer at a company, or if you were an advertiser, the last thing that you will cut is your check you write to Microsoft, or the money you send to Microsoft every month, and if you're an advertiser, what you spend on Meta. So that even if you do get sort of economic deterioration because of the tariffs or for whatever other reason, maybe they'll cut spending, these companies, eventually, but that it would be sort of a last stand or last straw or last resort that they would take.
Yeah, I mean, look, Microsoft, you obviously need to be in the cloud to play with anything when it comes to the enterprise now. And then when it comes to advertising, yeah, it's Meta, Facebook, whatever you want to call it, and Google. And, we did see declines, obviously, during COVID, but that was super extreme time. So that's all back now. And yeah, I mean, it does appear that they're weathering whatever kind of storm is coming or isn't coming or, nothing.
All right, let's move on to Microsoft, because those numbers are out as well. And we have that stock moving sharply up and more than 6% here in the after hours. It looks like on the bottom line, let's start there, Q3 EPS, I see coming in at $3.46. I don't see a compare yet on that. On revenue, though, I see the $70.07 billion. That is a beat. The street was closer to $68.48 billion. I'm looking for Q3 Azure, other cloud revenue, XFX, up 33%. The street was at 31%, so another beat there. And that helps to explain why, at least initially here, we're seeing a strong pop. Q3 Intelligent Cloud revenue, $26.8 billion. Street was at $25.99 billion. Q3 Azure growth attributable to AI, 16 points. Estimate was 15.6. So a lot of beats across the board here. We don't have guidance yet. As always, Microsoft would offer that after the bell.
And in particular, guidance on CapEx is going to be interesting, as well as the financial guidance coming from the company. Productivity and business processes revenue up 10% for the company to nearly $30 billion. Intelligent Cloud up by 21% to $26.8 billion. And then that more personal computing category for Microsoft up 6% to $13.4 billion. As you say, we have to wait for the call to get more. But Satya Nadella in the statement saying in the commentary here, cloud and AI are the essential inputs for every business. And Amy Hood, the CFO, talking about a strong quarter here. So not getting a lot of color commentary quite yet.
You'll get so on the call, the conference call. That's when CFO Amy Hood's you'd expect her to give you that guidance,
right.
More color about cloud performance, AI spending, capex plans. What do they say about Trump tariffs? Because you think about Xbox, you think about tablets, and what do they see ahead? Joining us now for more earnings reaction. Let's get to Brent Till, senior analyst at Jefferies. Brent, Microsoft numbers are out. Initial response positive, but interested to get your reaction to the report.
Hey, Josh, really good. I mean, Azure accelerated. It was 31 last quarter and went to mid-30s, 35% this quarter. So Microsoft had publicly guided for an acceleration, then had to pull back. They missed 2 of the last 3 quarters in Azure. So this is a good beat, pleasant surprise. Now they're 2 for 4 at the plate for making the numbers that they said. So I think everyone's still a little skeptical, but good to see the acceleration. M365, which is Office, that's 15% growth at the high end of guide, and revenue a little bit ahead, operating income ahead, EPS ahead. So far from what we can see, things are better than feared, but we don't get the guide until the call, and we'll have to hear. Remember, Amy Hood has never acknowledged there was ever a headwind, there was a blizzard, or a car stuck in a ditch because of black ice. So they will most likely continue to give a pretty bullish update and outlook. That's Amy's pitch, and it doesn't matter how cold or hot it is, she'll hold to we are going to execute, which is their marching orders from Amy. So we think that is again probably par for the course in terms of how they're going to guide. And I think again there were a lot of concerns about Microsoft and the durability. I'd say that most of the CIOs we speak with, Microsoft's the last thing they're going to cut in a downturn. And so even if you do see things get worse, which I think everyone's anticipating things are going to get worse, we believe Microsoft will be a better place to shelter than many of the other names we cover because of their durable franchise that cuts across applications, security, infrastructure, AI. And we continue to believe in the story.
I am curious, Brent, how cold is it going to get? How slippery is the ice going to get? In other words, if Microsoft's the last expense that CIOs want to cut, how bad would it have to be to see some kind of pullback? Can Microsoft continue to execute if there is a weakening environment?
The good news for Microsoft is they have the AI story, right? Remember a couple of years back, they started this push. They were the ones that, said we are moving into an AI economy, and everyone got caught flat-footed, right? Google, Amazon, everyone was chasing Microsoft's lead. And Microsoft didn't want what happened with AWS in the past cloud cycle for, they were trying to catch them. So I think they have the advantage where they've been AI first. They have a good portfolio. It's infiltrated every line of business, from apps to security to infrastructure to custom development. Nadella, the CEO, was on stage with Zuckerberg yesterday and said that, they both kind of articulated that between 30 and 50% of the code in the next year is going to be written by AI. Well, Microsoft owns GitHub, which is the one of the top, if not the number one place that developers go to help write their business applications. And so, again, no one's immune. Everyone's going to get impacted. I've been impacted. Many of us have been impacted already by what's going on. So no one's going to be immune. But again, when we're talking about relative safety, the durability, the breadth of Microsoft's product line, and then their AI first mantra, and then you have the single best CFO in software running the show, and you don't want to mess with Amy. So I wouldn't want to miss a number if I was in Amy's executive team.
Yeah, you don't want to miss with Amy Hood, for sure, Brent. Very well-respected CFO. I'm curious, conference calls starting soon. If you had the chance to ask Amy a question or two, what would it be?
What's driving the Azure acceleration, and what gives you confidence in the durability as we head into stiffer economic headwinds? would be one of the questions among 10 others that we have.
And Brent, I want to turn briefly to Meta here as well, because it is striking that this company is raising its CapEx spending plans for this year, as the numbers seem to also largely be ahead of estimates. What does that tell you?
You know, it's a contrast to what Snap said, and I think it suggests again the larger ad platforms are going to be in a better position. They had really good numbers across the board. You know, as you mentioned in your lead-in segment, you know, what's interesting is they raised CapEx. Everyone thought they would cut CapEx. They actually raised CapEx from 60 to 65 billion to 64 to 72. So I think it's giving. Zuck would only do that if he sees a return. And everyone says, well, Brent, these are like railroad companies. They're spending so much money in AI. Like, how on earth are we going to see the returns? You know, you're seeing it in 16% revenue growth, earnings numbers that were $1.20 higher, and they've done a really nice job executing. And all of our ad checks lead back to similar to what I said about if a CIO had to go to a deserted island, they would bring one vendor. They'd probably bring Microsoft. If an advertiser had to go to a deserted island, you only get one vendor to pick. You'd pick Meta because of the breadth of their offering, the quality of the return, the opportunity in wearable AI, the opportunity to improve the searchability of Instagram. You go through. There's so many different drivers in Llama. We've said this repeatedly. Llama is such a hidden secret, and I don't think I think most investors know about it. But like, we think Llama is like basically a Red Hat inside of Meta, where you have a free call option on upside in the stock if they can figure out how to monetize Llama, which is their LLM, and everyone in open source is going to them. They're not going to just DeepSeek. It's a Llama and DeepSeek world, probably even more of a Llama than DeepSeek. But those are the two open source platforms. Closed source, you're going to obviously OpenAI and others. But they have a huge opportunity with Llama. And so I think there are multiple drivers still at Meta that are really exciting. And the fact that they're raising CapEx is, to me, a great signal that their investments already are paying off.
Yeah, and a surprise, as you said. All right, Brent, we'll let you dive back into the numbers and get ready for the calls. Thank you so much for spending some time with us. Alphabet is out with its numbers now. The cloud number, which we had talked about being so important here, does look like it's a little bit light of estimates, although numbers overall beat estimates. Let's run through them. First quarter earnings per share, $2.81. That is 80 cents above analyst estimates. Revenue coming in at about $90.2 billion. That's above the $89.1 billion that was estimated by analysts, and that cloud revenue number at $12.26 billion, a little bit shy of the $12.32 billion that analysts had been estimating. But overall, revenue ex traffic acquisition costs, which is the measure that we look at for Alphabet's revenue most closely, $76.49 billion. That is ahead of about $75.4 billion that analysts had been anticipating. I also want to mention ad revenue here, because there's been all of this concern about, are we going to start to see, Google, like many of these companies we talk about in big tech, are not necessarily directly affected by tariffs. But if there is a decrease in ad demand or demand from businesses in some way, would they see it in advertising? They're not seeing it yet. Ad revenue at $66.89 billion. That is also ahead of estimates here. So that's something to keep in mind. YouTube ad revenue pretty much in line with estimates here as well. And the company is announcing some cash return to shareholders, a 5% increase in its dividend, and an increased buyback authorization of $70 billion worth. So pretty sizable addition to that here. The company's first quarter CapEx, should mention, $17.2 billion, which was also pretty much in line with estimates. I'm still waiting for the release itself to kind of update here to get some color. But just to get some instant reaction for you guys, Mark, I know you had some pretty big hopes for what we might hear from some of big cap tech. In the case of Alphabet, they seem to have delivered.
Look, Alphabet has had 8 straight quarters of revenue beats and make this number 9. So It's pretty impressive that they continue to operate at a very high level. 281 versus 201. We haven't had time to dig into the numbers all that much yet, but that's a pretty impressive beat on the, looking at not only revenues and earnings at a time when arguably the market made a short-term minor breakout today. So being that Google is 5% within QQQ, given the A shares and the C shares, I mean that's pretty encouraging, I think, for potentially what futures could do as a result of this.
Yeah, it's interesting to see sort of the 5% pop off these numbers, because I think one of the big questions with Alphabet, just reading through different analyst commentary on the street ahead of the release, was there was definitely a growing fear that maybe the numbers come in line or potentially even miss. It seemed like some of those whisper numbers were actually lower than sort of what consensus estimates were. And so I think when you sort of make sense of how the numbers came in versus that, it's a good read. Also, Julie, you had highlighted that CapEx number, and to see the CapEx number slightly above expectations versus being below, right? Of course, CapEx being a big part of what we're talking about with these companies. I don't think we got CapEx guidance yet.
No.
I think that comes on the call.
Yeah.
And that's sort of kind of the looming big question
Yes.
here, I think,
Yes,
right?
we'll
Is
have
if
to see.
if CapEx comes down later this year from what they were prior.
And one of the other big questions around Alphabet, around all of these big cap tech companies, is how are their customers using AI? Are they paying for it? What are they doing with it? We got a little bit of commentary around that from CEO Sundar Pichai here in this statement. He talked about search seeing continued strong growth. It was boosted, he says, by engagement we're seeing with features like AI overviews. He says that has 1.5 billion users per month. It's funny, AI overview. I don't know that I ever opted into it. It comes up every time I Google. So I guess that's why it has so many users per month. But he also says YouTube and Google One have surpassed 270 million paid subscriptions. So that's something to highlight as well. So interesting here. Again, on the call, we'll get more color around CapEx and around AI and what's going on there. I want to start with Alphabet here because this is the one that we are seeing move higher after the company came out with estimates, with earnings that beat estimates by a pretty wide margin, revenue beating estimates as well. Gil, I want to start with you here because we did see these numbers very strong. The cloud revenue number may be a little bit light, but it doesn't seem like investors are perturbed by that. What did you make of it?
Well, there's two things to like. One is the search business is still growing. That's what we're always bracing for here with Google. We know that everybody is now ChatGPTing instead of Googling. So there's this expectation that we're going to fall off a cliff. That may not happen until ChatGPT and OpenAI start selling ads. So for now, the digital advertising dollars are continuing to go to Google. Backward looking, that looks great. The other thing to really like is how much Google has cut costs. They beat on the bottom line by the most. And that's the relief that you're sensing here today, even though the cloud, let's call it, was in line, which again is a deceleration from last quarter, which was a deceleration from the quarter after that. So what we like is search still growing, very profitable, even though cloud was just in line.
And Gil, what do you think about the regulatory overhang that most of these companies still have to go through and the antitrust concerns? Is that something investors should still be concerned about?
Absolutely. The Department of Justice is hell-bent on Google not having a monopoly going forward. So breaking up the 3 monopolies that it says Google already has in order to prevent Google from having a monopoly going forward with chat. So instead of Google dragging its feet, which is what it's been doing so far, we think Google would be better off being proactive, spinning off these businesses. It would probably release value to shareholders, but it doesn't look like that's what they're doing. It looks like they're going to fight back, drag this out, which is going to continue to be a drag on the business.
Angela, I want to bring you into this and circle back around to search and ChatGPT's role in search here, or those AI summaries, because as I mentioned earlier, the company bringing up how many people are using those AI overviews, 1.5 billion users. But as I said, it just comes up when you Google. It's not like you opt into the thing. So I wonder how much added value that is bringing and how much that is really sustaining growth in search.
Yeah, no. So I think that's a great question, and I think it's definitely going to get asked on the call, and also going to want more clarity in terms of the AI monetization across Alphabet's overall business, right? Whether it be AI overviews, which is a clear emphasis of this company here over the last couple of quarters, especially on the search side of things, or whether it be Gemini across its ecosystem and how they can monetize Gemini. But our view as far as search is concerned is, and the numbers were really good in our view. You're talking about growth of 10% on a top line basis, for search as well as on YouTube. So it looks like at least in Q1, the advertising side of things looked fairly healthy. We'll see if that can hold up through the rest of the year. My guess is you're going to start seeing some deceleration across the advertising landscape as we progress through the year. So we'll kind of see how that plays out. But ultimately, we do think they're going to find ways to monetize this stuff. We want to see, where AI overviews plays in terms of the role here. But at the end of the day, I think, search here looks pretty good.
So let me ask you, Angelo. So a lot of these companies have reaffirmed their CapEx. We heard from Alphabet. I guess we'll know more at the call, but both Amazon and Alphabet seem to be very positive and really ignoring a lot of the effects of potential tariffs. Is that your view, that these companies are sort of just keeping their eye on the ball, and can they afford not to be more pessimistic about what's happening, or do you think they're still doing the right thing?
I think the opportunity right now is too great for you to kind of take, the foot off the gas on the AI side of things. So I think Alphabet earlier this month did reiterate their $75 billion CapEx plan. I think you're going to hear them reiterate it again here on the call. I don't expect any change whatsoever in terms of some of these hyperscalers for 2025. I think where the issue is at hand is clearly as we go into 2026 and beyond. I think that's really the risk for many analysts in the street out there. And literally, I think, what's going to be important here is the digital ad side of things, right? If that slows or rolls over here over the next couple of quarters because of macro uncertainties, the street is going to get very concerned about the sustainability of CapEx going into 2026. And that's where you get the fear of potential cuts. And that's where it potentially kind of rolls over into areas like semiconductors and provides downside on that side of things as well.
All right, we got the numbers here. So earnings per share coming out at 27 cents. That's below the 43 cents that had been estimated. Our revenue coming in at $19.34 billion. The average analyst estimate was for $21.37 billion. So missing pretty significantly, especially on the earnings front. And some of the other things that we're seeing here initially here, some comments that the tariff landscape will have a larger impact on the energy unit, that the company is going to revisit its 2025 guidance in their second quarter update. That is not particularly unusual right now in terms of what we're hearing from companies. Tesla says it's difficult to measure the impacts of global trade policy, but that things will stabilize in the medium to long term. The company also says that its plans for new vehicles is on track to start production in the first half of 2025. So still on track for that, we'll see. And that there is sufficient liquidity to fund the product roadmap, but the uncertainty could affect demand in the near term here. And it looks like there is not a return to growth forecast in this earnings report. So we'll see what kind of color commentary we get on the conference call related to that.
Yeah, and going along with some of that tariff comments here, Julie, going just through the presentation here, company talking about automotive energy markets continue, uncertainty continues to increase as a rapidly evolving trade policy adversely impacts global supply chain, cost structure of Tesla and our peers. This dynamic, along with changing political sentiment, interesting for them to call that out within the statement, within their presentation itself, could have a meaningful impact on demand for our products in the near term. So pretty forthright, commentary from the company here around the challenges facing the business. Now, I know I just gave a preamble about how the story is really about what Elon says and buying his worldview, and the company has generally viewed commentary to this effect, I would say, as again, very Wall Street, very numbers, you're not seeing the big picture. But I think for Tesla to come out and be pretty forthright about the challenges facing the business at this point in time, and you look at a miss of the magnitude we're looking at, a change in tone, I guess I would say, is a different sort of release, I think, from the company than you are typically want to see if you go back through the quarters.
The changing political sentiment really does pop out, right? Because when you think about sales not being as strong to start the year, right? Of course, disappointing, and really just a large part of that story, as we were highlighting a minute ago, we know that people are not that excited about Elon Musk's involvement in the new administration to the point that he's been involved. We've ran several survey datas, right? We've been covering this for the past couple months of people just saying that they're less interested in buying Teslas. So then I think my question is sort of spinning it forward, because we keep on saying how it's really kind of all about the call with Elon.
Yeah.
To what extent is he willing to talk about this, to maybe address any level of what does changing political sentiment actually mean? Are they aware of sort of how consumers are now changing their views on the company, and is that part of their actual calculus moving forward and something he's sort of considering amid all of this?
Yeah, and it also highlights, once again, the bizarre position of the world's richest man and head of one of the world's biggest companies being in this position in an administration with which he is at odds regarding trade policy. Clearly, everything that is in this report indicates that trade policy is not good for a company like Tesla, even though Elon has talked in the past, yes, they assemble or build their cars in the United States, but he is, he's at loggerheads with Peter Navarro, the trade advisor to the president on this issue. And again, it highlights the perils of being in the private sector and yet being so close to the political realm, not just for the actual political ramifications, but if what the administration is doing is against your shareholders' interests.
It's a challenging position because what Tesla said in the release is materially the same as what most companies are going to say versions of in their release. But to your point, Julie, most companies do not have their chief executive, in the Oval Office many days.
Yeah,
So
exactly.
That's a big difference there. Also, the stock's doing nothing, which is fascinating to me. I'm sitting here looking at the stock like, what are we doing? I guess we're going to wait for the call. Down 1%.
Maybe people are waiting for the call?
I suppose is fine.
It seemed like coming into the
market
report,
pricing an
though.
8% move, something like this?
Yeah, but didn't most people coming into the report think that the
Stock's
report
down
was
40% this year.
Yeah, no one really thought the report was going to be that good
That's fair.
anyway,
That's
right?
fair.
So you get a not good report, and kind of what do you do with these numbers again until you hear, I think, some larger questions that people want to know from us in the call.
There was a lot of commentary going into this that this would be a sort of reset year for Tesla. That it's not that the first quarter doesn't matter, in the words of Adam Jonas of Morgan Stanley, but it is more that you now have to sort of reset and look past this and see what happens next. We've been talking a lot today about what we're going to hear from Musk on the call in terms of his role at the company. You have said very firmly, like, Doge needs to go in terms of his focus. He needs to come back. Do you think we're going to get that today, Ross?
I do think we're going to get that. And I think we're going to get that also because his special government employee designation ends anyways at the end of May. So it's not like this is new information. I think he's just going to make it very clear. He's going to try to do anything to get the stock not to go lower. So he's going to say he's coming back to Tesla and he's going to be done with Doge and he's done his work and he's solved all these problems. And now, I'll be back. And that's, I think, the message that people want to hear. And that is probably the only thing that could get the stock moving higher. So I expect to hear that.
Ross, as you look at the stock slide over the last few months now, 40% drop, we've had multiple periods like this in Tesla's history. How do you think this period, is it analogous in any way, I suppose, to prior drops? And how have you thought about the story as we get towards what feels like a pivot point in where it's been over the last 6 months?
People aren't going to like this statement, but Tesla is fundamentally a different story than where it was several years ago. I mean, Tesla was a massive growth story. It was a young, amazingly innovative technology company building cars and software. And now Tesla is a very mature EV maker with a CEO who doesn't work there, who says horrible things about lots of people that won't buy their cars anymore. And the biggest issue Tesla has is people just don't want their products, even though they're the best products in the market. So I don't know how they solve this. So I think Tesla's best days are behind it at this point. And until something really changes in the direction and or leadership at the company, especially with the board of directors, to try to get the company back on track, I see sales continuing to decline and with that revenues, profits, and everything else. So energy storage can only save you so much, which it did save them in the quarter because that's been a very strong part of the business. But automotive sales were just dismal.
What about all the other stuff, Ross? All the other reasons that people own this stock, right? The cheaper car that is supposed to be in production by the end of the first quarter, the robo-taxi, eventually the humanoid robots, the AI piece of it all. Is all of that enough at this point?
Well, when you're an investor, you look at the future and you have to try to model out what that future looks like economically. And so obviously a lower priced car was the most sensible thing that Tesla could have built, and then they didn't build it. And now I don't know what's happening with this, but I don't think there's a lower priced car. So let's just move on from that. That a lower priced car is actually just a used Tesla, which you can buy for 20,000 or so online right now. So if you want a low priced Tesla, it's called a Model Y. You just go buy one. They're all online, used. They're great cars at a ridiculously cheap price. Then you have another problem because then there's so many used Teslas for sale, they have no reason to buy a new Tesla except it has a light bar on it. You know, the light bar on the Model Y and the new Model Y is very nice, but is it really going to convince a whole new legions of buyers when they don't even advertise? No. So then you've got robots and the future of cybercab. And the cybercab business is not a business I want to be in because I think it took Uber forever to make money. And now you've got Waymo's, and I'm in an area where Waymo is very active, and I watch Waymo's drive incredibly well every day while my full self-driving still is this clunky, software driving like a sort of like a 12-year-old. And so I'm really upset that the software doesn't work and it's not even comparable to Waymo. So Waymo's expanding all over the world now, and I just don't see how Tesla catches them. And Waymo's got money. And then lastly, I just don't see a world anytime soon where we have robots walking around and doing our laundry and stuff. So if you can tell me when that's going to happen, that's how long it's going to be till Tesla makes money. Well, that could be 5 or 10 years from now. So I don't know about you, but I got to make clients money every year. And Tesla just doesn't seem to be doing what it needs to be doing.
You know, Ross, you raised an interesting point about the cost of the car, because I know a lot of people who have been in like that, let's call it like that Audi, BMW sort of market, and they get a Tesla because it's a whole lot cheaper than those kinds of cars. But I think for a lot of people, it's sort of associated as like a luxury vehicle. Now, the company's been very forthright. They wanted lower cost cars. They make lower cost cars. You can get lower cost Teslas. And I'm just wondering if there's like a timeline here upon which the strategy starts to look more at premiumizing the brand rather than this mass appeal, mass robo-taxi networks, all those sort of things that have defined the company in the last, I don't know what it is, 4, 5, 6 years.
You know, I would argue that Tesla was a premium brand when it started, and it's, and I was worried about this many years ago, it looking a lot more like Toyota in the future than Mercedes and BMW. And that's what's happened, is it looks a lot more like Toyota now, and people don't consider Tesla a premium brand anymore. And so, the mass appeal brand works if everybody likes your brand, but if everybody hates your brand because your CEO supports like right-wing Nazi parties in Europe, it's really, really hard to sell cars. And so when you want to have mass appeal, I highly recommend that you act in a way that appeals to the masses. And so I'm not sure what Tesla is anymore. It's certainly not a premium brand anymore. I wouldn't consider it a mass brand because most people actually hate Tesla now. It's probably one of the most hated brands that I've ever seen, and it sucks. It's really sad that Elon's allowed this to happen to the company. So I'm not sure what they do with their brand moving forward, and I don't think they can be a premium brand, and nor are they focused on the premium market. If you look at a Rivian or a new Mercedes or BMW EV, they're so much nicer than Teslas.
Ross, every time we talk, we ask you if you still have the stock, either yourself or on behalf of clients. And it feels like you hold your nose and you just hold on to it.
Well, it's more the opposite. We acquired a lot of stock in the old days. We've owned it for 11 years and we've made a ton of money off of it. And for the last almost 3 years, we've been selling the stock. But it's really hard to sell, $100+ million worth of stock, easily, and there's a tax consequence that we've had to accept with that. And so I had a lot more hope than I have now that Tesla would right the ship, but now I think it's real tough and for them to fix the ship now. And so long term, I still think Tesla has the best products. I think climate change is the most important issue that humans solve over the next 10 years. Tesla makes the best EVs, the best software for EVs. It makes energy storage products, the best charging experience. And if they focused on this, they could be wildly successful. The EV market in the United States growing 10% or more. EV market globally probably growing 25%. This is a great business. There's nothing wrong with it. So I have in this hope that either a new CEO takes over and fixes the brand or Elon somehow changes or something, but my hope is running thin. And so, we end up selling the stock every week. We'll sell stock for clients depending on each client's situation. For many of our clients, they don't want to own Tesla anymore. So our position is about 40% of what it used to be. and we continue to whittle it down. But many people, our clients, very much care about climate in the future, and Tesla's still the best solution.
Russ, you talked about that possible executive change, I guess, get a new CEO. Is there I know Elon, has the comp package and has his control of the board and all that. Is there any scope on which a serious activist push could be made with someone who has enough capital in the stock that you could get movement? And I can see you kind of shaking your head here.
No, I kind of tried that in 2023 when I ran for the board, and I did get a lot of institutional support at that time. And one of the things I realized is there's no way that Elon's letting anybody on this board that isn't on his team. And everybody on the board is more than bought and paid for by Elon. And I realized what a mess I was getting into. So that's why I pulled out, because I just didn't want to be involved anymore, because the politics around that board is pretty bad. And so, the fact of the matter is that, right now, unless the board of directors is sacked, nothing's going to change at Tesla, and that's what needs to be done. And I think the attorney general, like in California, should be suing the board of directors of Tesla for negligence. And that's, I think, the next step for many of these institutional shareholders and pensions, for the damage that's been done to the pensioners from a lack of board oversight and violation of NASDAQ rules. So I think, the board needs to be replaced immediately. It's probably the worst board in the history of American business.
Wow, that's saying something, Ross. All right, well, as always, it's good to catch up with you. We appreciate you chatting with us about Tesla. Thank you.
Yeah, thanks for having me.
Tesla shares rising today after CEO Elon Musk vows to refocus on the company, taking a step back from his role leading the Department of Government Efficiency under the Trump administration. He'll be involved just 1 or 2 days a week. This comes after the EV maker's first quarter profits plunged 71% from a year earlier. The automotive revenue down 20% year over year. Here's Musk on the earnings call.
The large slug of work necessary to get the Doge team in place and working in the government to get the financial house in order is mostly done. And I think starting probably in next month, May, my time allocation to Doge will drop significantly.
Joining us now, Dan Levy, Barclays Senior Autos Analyst. Dan, great to speak with you. I know you predicted that a good narrative could outweigh weak fundamentals on the stock, but you still have a hold rating on it, even though that's exactly what we're starting to see play out in the stock market action pre-market this morning. Where do you stand with Tesla after these results?
Yeah, thank you so much, Madison and Brad, for having me. Look, I think this is the challenge with a result like this, is that you're balancing on one side what was fundamentally quite a weak quarter, gross margins that, while a little better than anticipated, were still in the absolute one of the worst levels we've seen in a decade plus, a reduced volume outlook, weaker commentary on margins as far as tariff impact, et cetera. But on the other side, you're balancing it against a more engaged Elon Musk and a robotaxi opportunity that is overall, I would say, fairly intact. So we try to be balanced with those two. That's what keeps us equal weight, but we acknowledge, hey, this is net probably positive.
What's the likelihood that they deliver all of these things on time? Robotaxi, humanoid robots. You've also got better mass market vehicle, more perhaps price sensitive to the demand in the market right now. What's the reality of them actually achieving these in the timelines that they've set forth?
Well, Tesla's never been very good on hitting their timelines. And they've had some products out there that have been, always concepts, right? Think about how long we've had Roadster in the works. Semi has never really ramped heavily. All of these things, have been sort of in the works. But overall, they've had a good track record in aggregate on ramping on some of their new technologies. It's just the timelines have always been mixed at best.
I guess, Dan, just help me understand. You said something fascinating, that you're keeping yourselves equal weight, but you acknowledge that this is probably net positive. I can't imagine someone telling me they're net positive on a stock after some of the numbers that we have seen on this print. Walk me through, what is it about this print that makes those abysmal numbers easy to look through? What am I missing?
Well, I think this gets to the fundamental question of how do you evaluate stock between fundamentals and narrative, right? And the pendulum is constantly swinging back and forth. At some point, weak fundamentals should play a role. And, just to give you a sense, our EPS estimate for 2025 now is now roughly $1.68. This is into the year. Consensus was north of $3. We thought that this could be a growth year. And in fact, with the tariffs, with weaker top line, it's a challenge. But I think we all know that Tesla is not a stock that you pick your 1 or 2 year out EPS number and apply a regular multiple. This is much more about narrative. This is much more about excitement. It's a comp to Bitcoin, right? That Bitcoin is something we always say is the closest comp. And as far as the narrative goes, what we got last night was it held in okay. And that's why net on this result in the very immediate term, it's probably net positive.
As we're seeing some of, as well, the kind of net positive price targets that are out there from some of the largest bulls in Tesla, from what you were mentioning a moment ago, in even the thought process around how Tesla could even be in the same neighborhood as an investment, perhaps, I don't want to say thesis, but the investment mindset that would even permeate around Bitcoin, that would say that Tesla is only able to get back to some of those most bullish price targets if there is a purely risk-on narrative that re-enters into the market. And maybe that's the wrong evaluation, but I'd love to know your thought process around what Tesla needs in order to actually reach some of those targets that are starting to be set forth by the largest bulls out there on the street.
Yeah, it's a couple of things. And I think you raise a good point. Definitely a risk-on environment, an environment that's more engaging of speculative assets helps. This is what we saw with the stock rally late last year, where it was completely disconnected from fundamentals. And in fact, anything fundamentals deteriorated on the margins, right? So a risk-on environment certainly helps. Look, I think over time, these growth opportunities do need to be judged. So we have to see where we are in terms of, okay, are they actually scaling on robotaxi and autonomous? Is Optimus actually materializing into something that's helping them? These are the areas where we have to see how this all plays out over time, and maybe that can help. But I think it's that plus, as you mentioned, returning to more of a risk-on environment.
Dan, good to see you this morning. Thanks so much for helping us break down some of the earnings.
Thank you so much for having me.
Certainly.